Today on Think Smart with TMFG, Mike and I are going to be discussing, does value matter anymore? Mike, there was a great article by Richard Bernstein of Richard Bernstein Advisors talking about today's market and value investing. And the reason for the article is that value investing has underperformed a little bit over the last 20 years. It's underperformed growth investing. And so Richard thought it would be a great opportunity to set the record straight. What is value investing? How does it work? And why will it always continue to work, I think is the premise.
Yeah, I guess you hear us talk a lot about a value premium. And again, we use dimensional fund advisors to run portfolios, and they always consider that one of the factors invested in that value will outperform growth over a period of time. But there will be, they always say, there will be periods of time where it's not going to outperform. And right now we're in one of those periods. But I guess this is the reasons why we're not changing strategy anytime soon.
So I always think of, in its simplistic form, if you think of value investing, if you do your grocery shopping at No Frills, let's say, or you're always going to Walmart to do your grocery shopping, versus going to, let's say, Loblaws or Pusateri's or Longos, where are you going to, at the end of a month period, if you've shopped just at the cheaper place versus the more expensive place, what's the difference in your grocery bill?
Oh, probably about 20% less.
Okay, 20. That's a pretty big difference.
Yeah.
Well, value investing is the same. If you buy companies that are valued at 20% less consistently, does that tend to work? Well, the evidence on value investing is it outperforms over the last 96 years by about 3% a year.
Yeah, and it's funny, when I go to Longo's versus Walmart, and I'm guilty of going to Walmart, I gotta say, because Longo's has some very shiny vegetables in it, right? And they're gonna look better. When you go through, the apples are really, really shiny. The oranges are all perfectly piled. I think they spray the vegetables every 4 minutes between them, so they have that nice shiny coat. I don't know what they spray them with, but
they look great.
They always do look good. But when you go to Walmart, it's not as good of an experience, but 80% of the stuff I buy when I go grocery shopping is canned or boxed anyway. To be honest, it's going to be the same from Walmart or from Longo's or Pusateri's
or Dollarama.
Yeah, but it's in a box. It has an expiration date. It's not beyond the expiration date. So I've tended to start to use Walmart a lot more for that type of thing.
Well, it's interesting. So, we're up at the cottage and it's the summertime, and there's a few places. So you've got a Foodland, which is, I'll call fairly good value.
Yep.
And next to it, there's a grocery place, a higher end grocery place. I go into the higher end grocery place, no matter which 3 items I buy, I'm walking out and it's $60. And I can't bring myself to go into that store.
Yeah.
On the way into Foodland, there is a furniture store. I go into that furniture store. There is not a stick of furniture less than $5,000. I can't go into that store anymore. I just can't bring myself to do it.
Yeah.
So I guess I've become a value investor and a value buyer. I've been buying value. I've been believing in a value strategy for our clients since about 1995.
Yeah.
And I believed it was the only way to go. And I really haven't deviated. And that's coming up on 30 years since that I started doing that. So let's go back to Richard's article. One of the basics that he talked about, and I think this is key, is every economic transaction that happens in the world, regardless of what you're buying, you have to pay attention to value. You're going to pay attention to value. You're going to pay attention, which is typically price, but tied into that is quality, service, reputation, all those things. But at the end of the day, whatever you do, you want value for what you
want the best price for whatever you're going to receive.
Right now, the market is behaving a little different. It's not paying attention to value right now. We've talked about the big companies that are booming: Google, Apple, Facebook, Nvidia. And what's happened is the market is ignoring everything else.
Yeah.
Why do you think that happens, Mike?
Well, people were looking a bit in the rearview mirror and seeing the massive growth that these companies have achieved in the past few years. And the human mind likes trends. We all like trends in our minds. And it means when something's going up, you assume it's going to continue to go up at that level. When something goes down, you're going to assume it's going to go down that level. People have a hard time accepting the randomness of returns and how they will go from going down to all of a sudden changing, going back up. People always assume that everything's going to be a very straight line. And I think that's what justifies people investing into growth stocks. That's the only thing that could ever justify it. It's the only reason to pay that type of, let's say, multiple for any of these stocks is to assume that they continue to grow at the same level they were in the past.
Mike, you told me recently that you're looking to buy a house maybe this fall. What type of house are you going to buy? Are you going to be looking for a value house or a growth house?
I'll definitely buy a value house.
So what does that mean to you?
So what it means, two things. Number one, if I take a look at right now the economic condition, the price of houses has flattened to come down a bit. So they've gotten a bit cheaper over time. Because of higher interest rates, that's brought the market cost down. And beyond that, when I go to buy a house, I'm a little bit handy at doing things. So I don't care if there's a broken door in the house.
Good.
So sometimes you pay a lot of money have all the perfect finishes in the house, and that's going to cost you a premium. I'm willing to have a few repairs to do here and there in order to get a much cheaper price. Because you know me, I'm cheap.
I do know you.
Yes.
You are cheap. It's interesting that you say that. I remember very early on, I had graduated from university, and I was backpacking through Europe with a friend, a good friend. And we'd go into these outdoor markets, and there would be some neat things on sale, especially in Italy and wherever we were, there was everything on sale. And my friend David would always say, especially, he'd go, "It's trop cher, Rob. It's trop." Yeah. And in French, that means it's too expensive.
Yeah.
And so at the end of the trip, I had bought quite a few things. David basically had nothing.
Yeah.
And because he found everything too expensive. But that's the way consumers, you're going to walk into a house and you're going to go, "No, that's way too expensive. We don't even want to look at that house. It's way too expensive."
Yeah.
You're going to go into another one and go, "That house is a bargain, but it's got a lot wrong with it."
Yeah.
Every single transaction we do, we look at price. We look at...
Our minds are trained from when we're kids. Our minds are trained to look for deals.
Lots of people like to buy morning coffee. If you're spending $4 every day and you're going to buy a coffee 5 days a week, that is $20 a week, $80 in a month. If you're buying a $2 cup of coffee, let's say you're going to Tim Hortons, that's $2, that's half the price, $40 a month. Over the course of a year, that's a big difference.
Yep.
You're saving $500 a year just on your cup of coffee every day. The world works that way. We don't, if everyone was just going to Starbucks every day, Tim Hortons would be out of business.
Yeah.
The stock market people are treating the stock market like we're going to Starbucks every day. Yeah. And they're forgetting all about the value companies. And what the evidence has shown long term is you're better to buy your coffee at Tim's. Yep. It's still just a cup of coffee.
But there's still a lineup at Starbucks, right?
There's actually a lineup in both places.
Yep.
I'm looking at buying a car.
Yep.
This fall. My lease is up. I'm going to buy a car. I like driving a premium car. I spend a lot of time in the car, but I don't want to overpay for that car.
Yep.
So I'm going to make sure I look at all the possible candidates. I want a luxury SUV, but I'm going to pick the one that offers the best value for me.
Yep.
I'm not going to buy the one that's most expensive, which is what investors are doing in the stock market today. Richard talked about an example, and I thought it was interesting to use this. So in his article, he said, imagine if you had one bank in town and 1,000 people who needed to borrow money.
Seems like a pretty good deal. You'd want that bank, wouldn't you?
Well, there's only one bank in town,
yeah.
And there's 1,000 people. The bank can pretty much charge what they want, right?
Yeah.
What if we flip that around and there's 1,000 banks in town and only one person wants to borrow money? What's competition like on interest rates?
Pretty heavy.
Pretty heavy.
Yep.
There's only one potential buyer and 1,000 people. So value investing believes investors should mimic the one bank in town with 1,000 borrowers. That's a better description of value. So if we flip it around and we look at a company with a cheap cost of capital, which means low interest rates and a high stock market valuation, that resembles the market being flooded with competing offers from tons of banks and only one person who wants a loan.
Yeah.
So that's what growth investing is.
The one person is going to get the loan is going to be okay, but the other ones are going to be, a bad situation to be invested in.
So today's market has become a bit of a seller's market because very few investors are concerned about valuation. They don't really care what they're paying for Nvidia. They're just buying it based on the fact that it's going up.
It's going to be worth more tomorrow than it is today.
Valuation, if you and I own a business, would we ever sell our business if its current value was underwater?
No.
If it was 20% less than we thought it was worth?
No.
We would hold on.
Yep.
But the market right now is only selling to businesses that are way overvalued.
It's a total non-concern for cash flow. And it's funny, I remember the best description I ever heard of the market is the price of any stock is always based on the future expected cash flows of that company. And that always works as a general way to invest, except in the growth situation. Growth ignores those future cash flows of the companies because there's no way you could ever justify the price you're paying based on future cash flows. Even when you see these big companies that take over, like you watch, I'll pick on Tesla for an example. Every car would have to be a Tesla to justify the valuations where it is. There's other things with those companies that may justify where that's going to go, but it's always things that have to happen to justify it. It isn't things that are happening to justify it. When you buy a simple, let's say, financial stock, you can justify the price based on what's currently going on inside of that company. No miracle has to happen to justify what the banks are trading at.
So Richard went into detail about optimism versus pessimism, and I'd never really thought of it that way. And he basically said value investing is based on optimistic growth, not pessimistic growth. Whereas growth investing, most people think it's based on an exciting future, Nvidia and AI and all the exciting things that go with it.
You can get in and out before it collapses.
Growth investing believes a few companies will control the market.
Yep.
Value investing believes that lots of companies have tremendous value and will grow to have their piece of the market share.
Much healthier situation, isn't it?
So what's the future look like, Mike? You and I have been doing this for a long time. We keep talking about that, but we've been through these periods before.
Value is sustainable. Growth is never sustainable because at a certain point, the valuations come into play. And unfortunately, it usually happens during poor market conditions. So when everything's going great, everyone's making tons of money, there's no unemployment, and everyone's cheap interest rates, whatever's going on out there, it creates this huge push toward this growth invested. But as soon as one thing goes wrong, and we've seen this multiple times. We saw it in 2001. We saw it in 2009. We saw it again just even after COVID situation. So we continue to see as soon as one thing pulls out, the puzzle has to be perfect for growth to continue. And as soon as one little thing goes wrong, growth falls apart. And then value continues to do what it's supposed to do.
So if you look at those two time periods, 2000 to 2002, 2007 to 2009, the growth market today completely resembles those two situations.
Yeah.
And you would be stupid not to realize that.
Yeah.
And value investors realize that. Yeah. What's tough about being a value investor is you have to be patient. It's like buying a house. Sometimes you may have to look at 100 houses to find the one that matches your definition of value for that house.
It was funny. I was watching this show on 2 weeks. I like cars and stuff. It was on these top fuel dragsters that are out there. And they do amazing things. They do a quarter mile in 5 seconds, something insane that they can do it in. But they have to rebuild the engine basically every time they do a quarter mile. They're built to go very fast and better than anyone else, but they have to rebuild the car after every quarter mile to do the second run. And you get that's what growth is meant. It can go extremely fast. It can go and accomplish massive things because it's built for that initial burst of speed. It's not meant to go for distance. It's not a Toyota. It's not going to go for the next, 300,000 kilometers.
That brings us to the end of another week. This is Rob and Mike with Think Smart with TMFG from the McClellan Financial Group of Asante Capital Management.
If you have any questions, please visit our website at tmfg.ca.